Good morning. It's Jeffrey Christian of CPM Group. It's a little after 10 o'clock in the morning of Friday, the 19th of April here in New York. I want to talk about the silver shortage chimera. There has been a lot of talk about how the world's running out of silver. Silver inventories are falling. There's massive deficits. Pretty much none of it is true. There are reasons to be bullish on silver, but those aren't really the good reasons. Before I jump into that, let's talk a little bit about where the markets are. Gold jumped up to about $2,433 overnight this morning. Silver got over $29 briefly. They've both fallen back and they're both off right now. I think gold is about $2,338 and silver's down around $28.35. They spiked up on the news that Israel had done some bombing in Iran, and then they fell back when the world realized that probably wasn't really critical to precious metals or the overall economy. Oil, for its part, fell 66 cents a barrel on the news. So it's where we are, pretty much where we were earlier in the week. Now, what's a chimera? I'm forgetting the Greek or ignoring the Greek monster that was named that. It's a thing that some people would hope or wish for, but it's in fact illusory and impossible to achieve. It's not saying that a silver shortage is impossible to achieve, but it's definitely illusory. There is no big deficit in silver. There's a surplus, and there has been a surplus since 2006. We've explained it before. We'll explain it again. In the silver market, when you have investors buying silver, they bid the price up so that they can get enough silver that they want. That means bidding the price high enough that you can have mine production and secondary recovery increasing the supply, and fabricators will cut back or reduce or substitute away from or reduce the per unit use of silver because of the high price. Right? Thus, a surplus in the silver market, measured properly, correctly, is total supply less fabrication demand. And a surplus appears when investors are bidding the price up, and deficits occur when investors are disinterested and selling silver. And if you look at this chart, you can see how that works. You can see that in periods of deficits, like the period from 1990 through 2005, investors were selling a lot of metal. Miners cut back on their production, secondary recovery fell, and fabricators were using this stuff very well because the price was trading between $3.50 and $5.50. In the mid-aughties, the silver price started rising. Investors said, hey, if I stop selling silver and I wait until tomorrow to sell it, I might get a higher price. It's the exact same thing that happened in 1978, 79, into early 1980. And it happened again in 2005, 2006. It's actually, as you can see, a longer-term process. There was much larger investors selling in the period from 1993 through 1999, 2000. And then the net investors selling, i.e. the deficits, were less from 2001 to 2005. And then they flipped into a surplus. So it's actually a multi-year process. You can see it coming. Similarly, the disappearance of that investment demand, as we saw in the late 80s, and as we may see again now, there's a risk there, leads to reductions in the surpluses. Investors are less interested in buying silver, and the price falls. Now, the price of silver has risen about 32% in the last 6 weeks. And I should point out that if you look at the data, the profit margin on primary silver producers last year was about 29%. And 80% of the silver mining comes as byproduct. So its costs may be $1 to $2 an ounce, depending on how the mining company cares to account for it. Yeah, if you're producing copper, lead, zinc, or gold, and you recover those metals out of your concentrate, your ore goes into concentrator, and then you start refining it out. You get those metals out. You have tank house slimes that have silver, and it costs $1 or $2 an ounce to refine that metal out of that sludge. So the costs of byproduct is much lower. Primary producers, the average profit margin last year on an all-in sustaining cost basis was about 29%. Goldman Sachs reported its first quarter profits this week. They had a 28% profit margin. A lot of people hate Goldman Sachs because they think it's a bunch of really smart, wealthy, intelligent, hardworking people, and they make a lot of money doing that. But the reality is that silver mining is almost as profitable as being Goldman Sachs. Anyway, we can see that the surpluses have been contracting, but the surpluses continue. Investors continue to be net buyers. And it's very important. It's very important that you understand that there's not a deficit. Silver promoters will add silver investment demand or surrogate numbers that they claim represent enormous amounts of silver investment demand on a net basis to fabrication demand, and then say, oh, there's a deficit, so you should be buying silver. Right? CPM Group, when we created the World Silver Survey for the Silver Institute in 1990, we used proper Commodities 101 accounting. Surpluses and deficits were calculated as total supply less fabrication demand. There were certain people at the Silver Institute who didn't like that. They wished that we could add investment demand and coinage into fabrication demand so as to have a more bullish posture. We said, we won't do that. So after our first 5-year contract, we didn't renew with them, and they hired other people who did that. And it's been a persistent inaccuracy in the gold and silver markets ever since that time. You don't put investment demand in your supply-demand calculations, and that way you know if the real fabrication demand, this is silver that is being used and is put into fabricated products. It might be jewelry or silverware or decorative items, but it also could be electronics and solar panels and mirrors and ball bearings and brazing alloys and ethylene oxide catalysts and a host of other things, including silver-plated glass, which has a energy efficiency standard to it. That silver that is used in fabricated products is not readily available in refined silver form. Silver that is bought by investors is available in refined silver form. It stays as silver bullion bars or coins, and it is in above-ground inventories. CPM Group always talks about above-ground inventories, not about available supply, because there are any number of silly people out there who say, well, my silver is not available. That may not be available at this price. It may not be available while you're alive. We'll talk to your heirs when they sell it. You know, the reality is that in silver investment demand, the silver stays as silver, and it's readily saleable. Investors, smart investors, want to know, is a market in a surplus or a deficit of fabrication demand relative to total new supply? Because if new supply is less than fabrication demand, then you've got a tight market and the price is probably going to rise sooner or later. It might be 15 years before it rises, but you see a tighter market. If the fabrication demand is less than total supply, then you know you have a fundamentally weaker market and the price is probably going to reflect that by declining somewhat until you see investors and fabricators using more silver, buying more silver. So the market's not in a deficit, it's in a surplus if you measure it properly. And it's been in a surplus for a long period of time. And the big concern right now is how that downward slope in the surpluses since 2013 compares to the downward slope that you saw in silver prices, in silver investment demand, net additions to above ground inventories from 1980 into 1990, when you moved into a deficit and the silver price had fallen from $50 on a peak, $21 average price, to about $3.50 in 1989, 1990, 91. We are running a risk there now, and the silver industry ought to be promoting silver to investors who will step up and buy more silver to keep the price high and move it even higher. So, in terms of the Chimera, there's no deficit, there's a surplus, the surplus is getting tight. It's just another way of looking at it. The red line is fabrication demand, the blue line is total supply, including scrap. And you can see how the blue line, total supply, has exceeded fabrication demand until over the last 15 years or so. Close to 20 years now, 18 years. But it's getting really close. And you can also see that the decline in the surplus reflects a sharp increase over the last several years in fabrication demand. So fabricators are, in essence, bidding the price up away from investors to some extent. It's a very complex situation, but it is a real situation. Again, we talk about above ground refined silver inventories. That includes coins, the green stuff here, which are a couple billion ounces now. It includes ETFs that hold physical silver. That's the blue stuff at the bottom. It includes exchanges, which is that little maroon section at the bottom, and dealer stocks, which are very small in terms of reported and estimated, and government stocks, which are also very small and estimated, and implied unreported inventories, which is the yellow stuff. Used to be most of it, but with the rise of coins and then later ETFs, you've seen a big shift of metal into ETFs and a big shift of metal into coins. And I point out that thing about the ETFs because it's very important. We're hearing people talk about how inventories are drying up. And the people who are talking about that focus on London reported inventories. And that's a big mistake because there's a lot of silver, most of the silver that's in above ground refined inventories doesn't exist in the London market and in the depositories that report to the London Bullion Market Association. It's very important. I'll get back to it in a second. But you'll see that when they created silver ETFs, which is around 2005, which is right when investors were picking up and becoming net buyers of silver again, you saw a very sharp, immediate increase in the amount of silver held in ETFs, about 500 million ounces in the first 2 or 3 years. That represented some fresh investment demand, but what it really represented was a lot of people who had silver in bullion form that they were storing either on their own or in depositories, often in 1,000-ounce bars, which went from around $5,000 in value to around $15,000 in value. They sold those 1,000-ounce bars and bought ETFs. They said, it's easier for me to invest in, buy, and sell silver through ETFs than it is with these bars. So you saw this initial surge of silver ETF demand, which it partly was people shifting out of bars. And you can see that there was a modest decline in the implied unreported inventories during that period of time. But the reality is that in terms of above ground refined silver inventories in coin form and in bar form, we're at a record level of around 5.5 billion ounces of silver. Most of it's not stored in depositories within the confines of the London LBMA reporting zone. There are depositories just outside that zone, and there are depositories elsewhere in England where silver is held by people who are producing it, refining it, using it, investing in it, holding it away from reporting depositories. In the mid-1990s, Berkshire Hathaway bought 139.7 million ounces of silver. They took delivery through the London market, and they immediately moved it out of London to depositories that were not part of the LBMA depository system. And they did that. They also moved it from unallocated inventories that other people had to allocated metal. And they did that so that no one ostensibly could see their silver. Warren Buffett's very smart, but you don't have to be Warren Buffett or a genius to know that if you're going to hold a lot of silver, you probably don't want it in a depository where the banks and others can see it. You want it on a private basis. There's an enormous amount of silver held in England in depositories outside of the LBMA reporting zone that doesn't get reported. There's also hundreds of millions of ounces of silver stored in Switzerland. There are dozens of depositories spread throughout China and elsewhere in Asia that hold silver that don't report that. In the United States, we've seen an enormous growth in depositories in Nevada, in Los Angeles, in California, broader California, Idaho, places where the silver is used or refined. Doesn't get reported in the Comex depositories. Comex has a zone you have to have your depository within a certain distance of New York City. Way back when, in the 70s, it was Manhattan. Then they expanded it to New York City. Then they expanded it to New York City and its environs. Then they expanded it to include Delaware and eastern Massachusetts. There are depositories that have been created within the Comex zone over the last several years that do not register with the Comex and are not registered depositories with Comex that service the physical industry, producers, refiners, fabricators, investors who don't want their metal stored in Comex registered depositories necessarily. If you talk to people who are in the depository business, there has been an explosion over the last 10, 20 years in the number of companies offering depository services and in the capacity to store silver. Silver depositories around the world, especially in the United States, in Europe, in China, keep building new silver depositories. And about the time they get it finished, they have that capacity filled. There are depository companies that have increased their silver storage depository capacity 4 times or more over the last 10 years as refined silver being held by investors and others moves into those depositories, but it doesn't get reported. So if you only look at London reported or Comex and London reported inventories, you might think that, well, Comex inventories are pretty high on a historical basis, but London inventories, which the reported data only goes back to 2016, about 850 million ounces, and say, oh yeah, but 500 million ounces of that is actually ETF metal, which will never come back to the market, even though it does. If you only look at London or London and Comex inventories, you might have the impression that inventories are relatively tight. But you're missing 90% of the market. You're looking at that little maroon band. You're excluding the blue ETF stuff, and you're excluding all of the other silver that's out there. And if you are involved in the market and you know about the incredible increase in silver depository capacity around the world, you know that people who are actually in the business of storing silver are not concerned that we're running out of above ground refined silver inventories. Now, question is, okay, those inventories are held largely by investors. There are maybe 1 billion ounces held by banks and trading companies that lease that silver out on a rolling basis to fabricators and refiners and smelters and producers. But the vast majority of this 5.5 billion ounces is held by investors. And you say, well, those investors will never sell. Well, some investors will never sell. I mean, I have silver that I've owned for 40 years now. But I also buy and sell other silver to take advantage of shorter-term price moves. Right? If you're an investor, you will buy and you will sell. Silver stackers say, well, I'm not an investor and you shouldn't count my silver as investment demand. Silver stacking is a form of long-term investing. You may not realize it, but that's what you're doing. You are investing in silver. You might say, no, it's not an investment. It's a form of money that I'm holding until the financial system collapses. But what you're really doing is investing in silver. And there is this enormous amount of above-ground silver inventories. And smart investors, as we saw the last few weeks, will say, gee, the silver price just rose 32% in 4 weeks. I think I'll take some profits. So you have seen some of this metal reflow, and you will continue to see it. Right? So you look at together, no deficit. We're not running out of above ground refined inventories. The silver market doesn't face a shortage of silver. Silver use in photovoltaic panels has been another subject that's been up there. Yes, it has increased. It hasn't increased as sharply as some people say. These are numbers that are based on information that comes from the solar panel manufacturing industry, people who are actually using the silver, right? So you can say, well, you know, CPM Group, you talk about all these guys who run depositories, and I'm sure they're all lying to us so that we're not panicking about the price of silver rising. And you say that you talk to all these people who actually use silver making photovoltaics, but they're probably lying and they're probably using a lot more silver. But if you want to live in a world where everybody's lying to you, if everybody is lying, if what they're telling you doesn't jive with your conspiracy theory, you're welcome to do that. But you're probably missing out on reality. You're probably worried about that Chimera. This is data from the International Energy Agency's 2023 World Energy Outlook. And I don't know how well you can see it, but that blue line is what they call the STEP solar photovoltaic panel capacity additions. And the yellow stuff and the blue line in the yellow zone represent their projections between 2022 and 2030. And you can see a very sharp increase in the capacity additions over the past 10 years, 20 years, and then a plateauing out over the next 10 years. And one of the reasons why they say that is the dotted blue line, which I hope you can see. That is the capacity utilization rate. And you can see in the early days of the growth in solar panels, it was up around 40, 50%. It spiked up to about 58%, but capacity started coming on stream in the last decade, and the capacity utilization rate has fallen below 40%. And their projections are that it will continue to be below 40%. even though you have this capacity coming on that is scheduled to come on stream over the next 7-8 years. An industry that runs at 40% capacity has profitability problems. So you can look at where we've been and say, okay, it's growing, and that's good because it's solar power. You know, I put in solar panels 6 years ago or so, and don't pay for electricity anymore. That's great. Yeah. But you can look at what's happened, and you can look at what's likely to happen, and you're probably going to be less bullish and less concerned about 800 million ounces of silver being used in the solar panel industry next year, because that's not going to happen. Silver use in auto applications also has taken a lot of attention. It has risen sharply since 2010. That doesn't necessarily reflect auto electric vehicles. Electric vehicles are in there, mostly in the last 5 years. Electric vehicles use maybe 2 ounces of silver, 1.5 to 2 ounces of silver per car, while a typical light-duty vehicle with an internal combustion engine uses about 1.25 ounces per car. What's really been happening is that cars have been loaded down with ever more electronics, gadgets, doors, windows, windshield wipers, all kinds of stuff. And that's been the major factor fueling the increase of use in automotive electronics. That's all I have for now. Sorry that it's taken 26 minutes to say it. Don't be fooled by the concept of a silver shortage. It's a chimera. It's an illusory dream that some people have. It's not reality. There are reasons to be bullish on silver. CPM Group has silver prices rising very sharply over the next 2 years or so, based on the realities that we see in the silver market measured accurately. Take care of yourself. Take care of those around you. Have a good weekend. Try to do something good for the world. I'll be tending my garden for a part of it, and we'll see you next week.